Hey guys, Gavin Shnieder here with Abode-based real estate. Today I want to talk to you about the new tax structure and specifically how it applies to real estate. I think there's a lot of misinformation out there, dare I say fake news, about how the GOP's new tax structure is going to affect our real estate here locally and nationwide. So the first thing we're going to talk about is the mortgage interest deduction. There was a lot of concern that the mortgage interest deduction was going to be eliminated. That did not happen. Now, some changes were made, though, to how the mortgage interest deduction is limited. So the new limit on amount of deductible mortgage debt is $750,000. Now, it was previously $1 million. This applies to all loans that are taken out after December 14th of 2017. Now, homeowners can still refinance their debts as long as the mortgage was originated before December 14th, even if it's up to that $1 million cap. Now, moving forward, the cap is $750,000 of mortgage debt. What that means is, assuming you're putting 20% down, which is generally the case at these price points, the real kind of impact is folks buying homes between about $940,000 and $1.2 million. If the home price was that much, you're not going to be able to deduct the mortgage interest between those two amounts. You can still deduct the amount up to $750,000. You just can't deduct it between $750,000 and $1 million. Now, that's only if you itemize. If you are not itemizing your deductions, then you're taking the standard deduction, which we'll talk about at the end. It's not going to impact you anyways. Now, the new tax structure does repeal the deduction on interest paid on home equity debt, with the caveat being that if the home equity debt was to improve the residence, then you can still deduct it. But if you're taking out a home equity line of credit or home equity loan to purchase a boat or a car or something, you can't deduct that interest. Okay, number 2 is state and local taxes, or SALT. There was a lot of misinformation out there going around saying that the SALT deductions have been eliminated. They have not. However, they have been capped at $10,000 in itemized deductions. So SALT is state and local taxes, which includes your property taxes. So this is primarily going to affect folks who live in very high property tax areas, or if they live in states that have income taxes. Now, Washington does not have an income tax. Our property taxes are fairly reasonable, but if you have very high property taxes, there's a chance, if they're over $10,000 included within the other state and local taxes that you pay, that you're not going to be able to deduct all of those if you itemize. But folks in California or in New York, those kind of areas who have high income taxes as well as high property taxes, their deductions are going to be limited. Now, number 3, the third kind of item that had the most amount of misinformation spreading about it was the exclusion of gains on the sale of your primary residence. So there was concern that it was going to be changed to you had to live there 5 out of the last 8 years in order to take an exclusion on the capital gains when you sell. That's not the case. Nothing changed. It's simply 2 out of the last 5 years you needed to occupy it as your primary residence, and that will allow you to take the capital gains exclusion. For single folks, it's up to $250,000. For married people, it's up to $500,000. Meaning when you sell, and using kind of a complicated formula, you net a certain amount of money, you can take up to $250,000 or $500,000 tax-free. Okay, so those are the 3 biggest items that I've seen a lot of misinformation about. Again, to recap, it's the mortgage interest deduction. It's the final version is it's reduced from $1 million to $750,000. Number 2 is state and local taxes, which are now capped at $10,000 for itemized deductions. And number 3, the exclusion of gain on sale of a principal residence. no change to that. Now the kicker here is, and we're not going to get into all the different items of the tax plan, but the kicker here is the final version of the tax plan nearly doubles the standard deduction for both single and married folks. For married, it's up to $24,000, single up to $12,000. So the vast majority of people will not itemize anymore, and they'll simply take the standard deduction. So if you paid $5,000 in property taxes and you paid $8,000 in mortgage interest, that's $13,000 of potential deductions. And you probably paid some sales tax and a few other things, and you probably paid some student loan debt. But you would have had to have paid another $11,000 in potential itemized deductions to get to that $24,000. It's highly improbable that your kind of average family in our area with a $300,000 house is going to need to itemize deductions. If that is the case, now you're capped at $10,000 for your SALT deductions, and you're capped at $750,000 in mortgage debt for itemized deductions. But the vast majority of people are not going to itemize anymore. So the net effect here is positive. The American people have long demanded that the tax structure close loopholes and limit deductions for the wealthiest Americans. And with capping the mortgage interest deduction at $750,000, capping SALT at $10,000, in addition to a lot of the other changes in the tax plan, that has been accomplished. Not to mention, we haven't even begun to talk about the lowering of taxes, the lowering of personal tax rates in the various tax brackets, which will have a net positive effect for the vast majority of Americans. So I think the net effect here is positive for all of us. So I hope that clarified a few things for you. Let me know if you have any questions. I'll add to the end of this, I'm not a CPA, so please talk with your CPA prior to making any decisions related to your accounting and taxes. But I hope this was informative, and we'll talk to you soon.